There have been several news stories recently about reverse repo rates and how they've spiked to all-time highs. So in this video, we're going to look at whether those stories are true, what the reasons behind that spike might be, but also the consequences for markets and how it's likely to play out. Here's an example of one of those stories I was talking about, which is from Reddit. And I think this one is slightly misleading in terms of what it's suggesting is the cause for the spike in reverse repo rates. It starts off okay. It says that the US loaned banks money, which is kind of true. It also says that the government's worried about inflation, which is also true. But where it starts to go wrong, I think, is when it introduces hedge funds or hedgies. Now, personally, I find that very unconvincing. So let's look at some alternative explanations which I think are more likely behind this spike in repo rates. And let's start with a definition of repo and reverse repo. This is what a repo transaction looks like, and it's short for the phrase sale and repurchase. Usually these are overnight sale and repurchase agreements. And in this transaction, you can see Big Bank above me here, and they're going to sell some of their treasuries, which they hold on their balance sheet, to the Federal Reserve. Then the Federal Reserve receives the treasuries onto its balance sheet, and it gives cash in return. So the net effect of this repo transaction is to take treasuries off the balance sheet of the bank and to inject cash into that bank's balance sheet. So repo transactions are a way for the Fed to inject money or liquidity into the banking system. Now, usually that's in the hope that the bank will then lend that money out to the real economy, and then hopefully that will stimulate economic activity. Now, as you might guess from the name, reverse repo is exactly the same as repo, but just the other way round. So now what happens is that the Federal Reserve takes some of its treasuries, which are on its balance sheet, and sells them to Big Bank. Big Bank takes those treasuries onto its balance sheet and hands over cash to the Federal Reserve. So this has the opposite effect, which is to drain liquidity out of the banking system. But of course, the other effect is that Big Bank now has treasuries, whereas before it had cash. So just bear in mind that the Fed has a huge amount of treasuries on its balance sheet, and reverse repo is a way for counterparties to get their hands on those treasuries. I think the real story here is about a shortage of US treasuries, and in particular, treasuries with a maturity of less than 1 year. They're called T-bills. And that story about the TBill Squeeze comes in 5 parts. And the first part of this story is commercial banks having too much cash. Now, you might be a bit surprised to hear that banks don't want too many deposits with their bank. But the fact is that the deposits sit on the liability side of their balance sheet. The profitable part of their business is on the asset side, and that's the loans that they make. And if you take 3 of the huge US banks, that's JP Morgan Chase, Bank of America, and Citigroup, you can see the size of their loans, which are in pink below me, have been pretty much flat. If anything, they've fallen recently. And that's because demand for loans has been weak. But unfortunately, at the same time, the size of their deposits has increased quite substantially. Why is that bad? Well, having greater numbers of deposits increases the size of the balance sheet of the banks. And in turn, that means they have to hold more regulatory capital. Now, that money is effectively dead. It doesn't generate an income, whereas loans would. So this situation of having greater deposits, but not greater loans, means that they become less profitable. And the situation isn't helped by something called the supplementary leverage ratio. Now, up until March 2021, banks were kind of let off the hook, and they didn't have to hold regulatory capital against treasuries and deposits. But then in March, that leniency expired, and they did have to hold more regulatory capital. So perversely, this is actually making the situation worse, as we'll see. Another factor is the US debt ceiling. If the US broaches a certain degree of debt, it has to be agreed by Congress. But during the pandemic, there was an easing of that requirement. But the debt ceiling is now going to kick back in at the end of July, and I've marked that in with a dashed red line. The blue line here, that's how much money the US government has with the Fed. And when the pandemic hit, they drummed up a huge amount of cash in that account in order to have the stimulus programs which they'd later enact. However, not all of that was used immediately, so it was just sitting in that Treasury General account with the Federal Reserve. But notice what happened to that Treasury General account as we approach the debt ceiling. By design, the Treasury has been spending that money. And that's why this balance is dropping dramatically. And what happens to that money when the government spends it is that it ends up on the balance sheet of commercial banks, which, as we've seen, then have to post more regulatory capital with the Fed. So sure enough, as the Treasury General account fell, so bank reserves at the Fed increased. So the US debt ceiling is another reason why US commercial banks are currently flush with cash. So what are these commercial banks doing about having too much cash? They're actually telling companies not to deposit their money with the bank. Instead, they're telling their corporate customers to put their money into money market funds. Now, money market funds are really boring funds. You get super low returns, but also super low risk. So if you put $1 into a money market account, what you actually hope is that you'll be able to take $1 out. You don't put money into this fund for return, it's purely for safety. And what these money market funds must never do is break the buck. How can they achieve that? Well, they buy the safest asset on the planet, which is short-dated US Treasuries. Those T-bills that we mentioned earlier. These are loans to the US government which last for a period of a year or less. So what these US banks, which are cash rich, are doing is telling their corporate clients to put their money into these money market funds. And the reason why they're doing that is to avoid additional capital requirements because of regulations. They're essentially saying to their customers, don't give us your cash, we don't want it. Now, a consequence of that is that the size of these money market funds is increasing very rapidly. So this is the amount of money which is being managed by money market funds in the US, and you can see that it rose during the global financial crisis quite significantly, but then as things improved it fell again. But since Q3 2018 it's risen massively. In fact, it's risen by more than $2 trillion, with much of that increase happening at the end of 2020 and the beginning of 2021. Now, as the size of these money market funds increases, they have to go out and buy lots of safe assets. And the safest assets of all are, of course, US Treasuries, the short-dated T-bills. And somewhat inevitably, these money market funds are running out of T-bills to buy. And the situation's actually been made worse by the Federal Reserve, because what they're trying to do is to buy $120 billion worth of treasuries and mortgage-backed securities every month, such that currently they hold a lot of intermediate maturity debt, so that's notes, but also lots of long-dated debt, in fact $4.4 trillion worth, alongside $2.2 trillion worth of mortgage-backed securities, and about $330 billion worth of T-bills. Now, you might have thought that the US Treasury would be issuing more T-bills so that this squeeze wouldn't happen. In fact, exactly the opposite is happening. Part of their policy at the moment is to make their funding cheaper in the years ahead, and they're doing that by locking in more long-term debt at the moment. So they're issuing more of those intermediate maturity notes, so those are 2-year, 3-year, up to 10-year loans to the US government. And they're also issuing loads of really long-dated US government bonds, so that's 20-year and 30-year, but they're actually reducing the supply of T-bills, and those are bonds with less than 1 year to maturity. So the situation at the moment is that there's huge demand for T-bills from money market funds for the reasons we've said, but at the same time that huge increase in demand is being met with a shrinking supply. And the inevitable consequence of increasing demand and a lack of supply is that the price of short-term debt has increased. Now, when the price of a bond goes up, the yield goes down. And if we look at the yield on T-bills, currently they're almost zero. The rate here is 0.05%. In fact, the return on some money market funds is now so low that they've waived their management fee. That's because their management fee would be greater than the return on the fund. So what can these money market funds do to address this squeeze in supply of T-bills? Now, is there anyone around who has a large supply of US Treasuries? Oh yes, the Fed. And as we said at the beginning, one way to get your hand on the Fed's supply of Treasuries is via reverse repo. So that's exactly what the money market funds are doing. And finally, we get to this graph which you'd have seen in all these news stories about reverse repo. This is the amount of reverse repo transactions which the Fed is currently doing, which is an all-time record. But given this perfect storm in the T-bill market, it seems quite reasonable that that would happen. So I think the real story here is about a shortage of T-bills, and that's a direct result of a combined fiscal policy, that's US government spending increasing, at the same time that we have monetary policy buying huge numbers of treasuries. And that's created a squeeze in this market for T-bills, which has to resolve itself somehow. Now, obviously, this is bad for money market funds. It certainly is a crisis in that sector, but I think it's got nothing to do with hedge funds. So I think that is a misleading story. But I don't think it's a crisis for the broader market. What we will see probably as an outcome of this is that the Fed will have to start thinking about raising interest rates and buying less treasuries. In other words, lift off, which always scares equity markets. So that might cause a little bit of turbulence ahead. Now, if you do want to keep abreast of this and other economic stories, but also market stories, which often intertwine, then a great way to do that is by signing up for our free weekly market roundup. I try to keep it topical and interesting. Hopefully I succeed, but you be the judge of that by signing up for it. To sign up for that, just click on the link above me and in the description below me. And as always, thank you for listening.